We are back. Markets have been resilient in the face of today's news out of the Middle East. For more, let's welcome Goldman Sachs' global head of hedge fund coverage, Tony Pasquariello. It's good to see you. Welcome back.
Thanks, Scott.
What do you make of the market? It's a pretty interesting market.
Very interesting. So let's start here. Obviously, a very fluid, very complex geopolitical backdrop. I would say if you were to observe kind of the constellation of market moves, if you were to observe client activity on our trading floors globally, very much a sense of calm. So why is that? I think in this context, crude oil is my true north. I think the options market gave you kind of an interesting tell going into the weekend. So a bit of risk premium in the front end of the options market, as well as the futures market. Not much in the back end. So, for example, like a 12-month expiry option on crude oil was trading below the implied volatility, was trading below the average of recent times. So the oil market was telling you in a very discrete sense, yes, there's some near-term event risk. It is not anything more than that. It's not a longer-term risk. And that's exactly how kind of collectively markets are trading this today.
You used the word calm when talking about your clients. We're talking about hedge funds, biggest investors, right? The word has been that they have not been on the bullish, this market's going up train. They've been a little slow to react to, I don't know if it's a fast-moving market, like a wall of worry. It continues to climb. Is that fair? Is sentiment changing to the positive among hedge funds?
I think that's fair. So if I use my kind of preferred gauge of -10 to +10 to characterize positioning, I put current length held by the hedge fund community at like a +5. That is both the discretionary crowd as well as the systematic crowd. I've been on the road a lot. I was in Chicago. I was in London last week. I'll be in Boston this week. And it kind of checks out anecdotally what we see in our data set.
What gets +10 then?
I think a clean move up and through the highs on incremental good news.
Got to see it first to believe it.
I think that's probably right. And if we were sitting here when the highs were made in February, or even at the end of last year, or maybe even last summer, I would have put that length at like a 7, an 8, or a 9 out of 10. So relatively speaking, I think the hedge fund community is pretty sober in the risk.
What about within the market? Part of your note out over the last couple of days was that sentiment around tech has warmed, I think was the word you used, correct?
Here we are again. I think it kind of goes back to this conversation you and I have had year after year, which is for all the challenges, tariffs, DeepSeek, here we are with capital starting to make its way back to the kind of the world's greatest companies, U.S. mega cap tech. And I think it's really rooted in this idea that no other set of companies are generating capital, returning capital, in reinvesting capital on the order that the Magnificent Seven is. And even away from the Magnificent Seven, just in recent weeks, what we heard from Oracle, what we heard from Broadcom, I think affirms that thesis very much.
I mean, you've been a keep it simple, keep your eye on the prize kind of thought about this market. That doesn't sound like it's changing at all. I mean, are you ready to declare a broadening a bunch more winners than you might have thought?
I'd say my highest level of conviction still resides in the tech space and then kind of like the attendant power theme. So I'd keep my eye on those two themes very much. This question of the broadening or not, I find it a little interesting. Within large cap, things have been pretty broad. I think there's 11 headline sectors of S&P 500. 9 of them are up on the year. So I'm a continued believer in S&P 500. I'm much less of a believer in small cap.
When you assess what's happening in the Middle East, as I said, no market participant here is going to be a geopolitical expert, but you're thinking about scenarios in which you'd be more or less bullish. If what we saw today in the response by Iran is the bulk of their response, at least from a military standpoint, you take from that and you mean what?
So I would level set it again in crude oil, which is my North Star.
That's whatever crude does, is you're going to decide what you think equities do?
I think locally that's going to set the tone for risk. And so our view going into the weekend was Brent crude oil was going to $60 by end of this year and into the mid-50s next year. We have not revised that forecast. So that should be, again, short-term a good backdrop for risk. I think the bigger picture is we still think it's a bull market. We think U.S. growth holds up and gets back to trend next year, plus 7% earnings growth this year, plus 7% next year. As earnings goes, typically, as we know, so goes the market. And so we've got S&P going to 6,500 out 12 months. I think that's a reasonable base case.